Hi everyone, my name is Aman and this is SMC Wolf FX. Today you will learn about what the Fibonacci retracement is and how you can use it to determine optimal trade entries. In the context of the Forex markets, the Fibonacci retracement is used to measure key levels within price to determine an optimal trade entry. But let's talk a little bit about the history of this concept first. An Italian mathematician called Leonardo Fibonacci is claimed to have first discovered the Fibonacci sequence, which is a series of numbers where each number is the sum of the previous two numbers. For example, 1 plus 1 equals 2, 1 plus 2 equals 3, 2 plus 3 equals 5, and so on. As time went by, people began to observe these numbers occurring within nature, such as the number of flower petals. For example, many flowers have 3, 5, 8, 13 or more petals, all being numbers in the Fibonacci sequence. Another example, we all have two hands, both of which have 5 fingers, and each finger is divided into 3 parts. All of these numbers again are Fibonacci numbers. These numbers became even more interesting when mathematicians found something called the golden ratio of 61.8% occurring within the Fibonacci sequence. For example, 21 divided by 34, 34 divided by 55, and 55 divided by 89 all equate to give you 61.8%. And this golden ratio is used as a key price level by many traders as a reference point, which I'll be showing you shortly. It didn't take long for people to begin exploring different directions of division and multiplications, searching for connections between the Fibonacci sequence and other ratios. If it occurs within nature, why not within the Forex markets? Hence the following ratios of 23.6%, 38.2%, 61.8%, and 78.6% were formulated to become Fibonacci retracement levels used by traders to plot key points within the markets. Now that we've gone over some context of what the Fibonacci is, let me show you guys my personal Fibonacci settings which I use on a day-to-day basis when it comes to trading. As you can see, I have the 0% and 100% being the total range of price, with the 50% to mark out the equilibrium point of a range, and then I've got my rounded ratios of 62% and 79% along with the halfway point of these two ratios of 70.5%. So pause this video if you want to transpose these settings across to your charts as well. Now let me show you guys on how to use the Fibonacci retracement to mark out key levels on the charts. Say for example here on the left we're in an uptrending market. You'd start by identifying your previous high and previous low points, from where you'd then use the Fibonacci retracement, marking out the 0% at the previous high and the 100% at the previous low, where the 62% and 79% area being your optimal trade entry zone. And then vice versa in a downtrending market as shown in this illustration on the right, where you'd start by identifying your previous highs and lows, but now marking out the 0% point at the previous low and the 100% point at the previous high, again with the 62% to 79% area being your optimal trade entry zone. Of course, when it comes down to actually trading, it is highly recommended to use the Fibonacci merely as a guide in line with other institutional reference points such as order blocks and fair value gaps, which I'll show you in some case studies next. Okay, let's go through some case studies now. So here's the 4-hour chart for the euro versus pound sterling, where we were in an uptrending market environment. As pictured, you can see the Fibonacci being marked out using the previous high and previous low points. As you can see, price delivered down into the 62% golden Fibonacci ratio, allowing the market to correct price inefficiencies in the form of a fair value gap before continuing its bullish momentum. Here is the 1-hour chart for the euro versus Japanese yen, where we were in a bearish market. Using the Fibonacci to mark out the previous highs and lows, you can see how price traded back up into the 62% to 79% Fibonacci range, which was also in line with a 1-hour order block. price experienced a form of market accumulation where you had the opportunity to enter short trades, and as you can see, price continued its bearish trajectory from this Fibonacci range, creating a new lower low for this trading pair. Finally, I want to show you guys a slightly advanced analysis of a swing trading setup, which I am currently keeping my eyes on, where I am utilizing the use of the Fibonacci retracement. What you're looking at right now is the daily chart for the euro versus pound sterling, where I have marked out the first Fibonacci from the halfway point down to the previous low of the bullish price rally, where I expect price to trade into a daily order block which is in line with the 62 to 79% Fibonacci range. Then I expect the market to turn bullish, trading up into a 1 hour order block which is in line with the 62% golden ratio of the Fibonacci marked out from a forecasted price low up to the previous high. I hope you found this video useful, and I advise you guys to backtest the Fibonacci retracement on your charts and see what you discover. Now, thank you for watching this video. Don't forget to like, comment and subscribe for more content, and check out our public Discord server which is linked in the description below.